In the next set of lecture examples, we look at rollovers. Now again, I'm not going to go through every single one of them, but what I want you to see is that example 1 talks about paragraph 65. Paragraph 65 is the involuntary disposal of an asset. And then I want you to see, we have example 2, which talks about paragraph 66, which is they just call this the reinvestment in assets, so not involuntary. Now guys, you'll see I've made a comment to you also that these examples are deliberately kept very similar, example 1 and 2, because I want you to compare paragraph 65 and 66. So you'll see that for the most part they are the same, but where do you need to look out for differences? Right. The biggest difference, the most important one here, is paragraph 66 does not apply to any building. Now remember guys, when we're looking at paragraph 65 and 66, we have a situation where we had one asset, asset 1, and then you replaced it with asset 2. It might even be more than asset 2. It might be asset 2, 3, and 4, whatever. But you have a situation. Paragraph 65 says you can have any asset and replace it with any asset. Paragraph 66 says you must exclude buildings. Asset 1 can't be a building, and asset 2 also can't be a building. Doesn't mean that both have to be buildings, but if one of them, either 1 or either 2 is a building, paragraph 66 can't apply. Now, what happens if paragraph 65 and 66 applies? Then the capital gain is deferred, and if the capital gain is deferred, then section 8.4e will apply, which then says the recoupment is deferred. And how do you write it off? You recognize it over the write-off of the new asset. So in this example, R Limited is a registered VAT vendor for 31 December year end. R Limited purchased asset 1 on the 1st of August and brought into use on that date, so in the 2013 year. Asset 1 had a cost of R1,000,000. On the 31st of July, asset 1 was destroyed in a fire. That is an involuntary disposal. R Limited's insurer paid out the market value of R1.2 million, and then they bought asset 2 and started using it from 2015 November. So that's when they started using. Now guys, what is very important here is that 1.2 million rands. Right, that 1.2 million rands, the new asset, so which is asset 2, must cost 1.2 million rands or more for this to apply. If it's not, can't apply. So let's look at the example. So the first one is a factory building. Now guys, this is an involuntary disposal, so paragraph 66 will apply, and if paragraph 66 applies, you can replace any asset with any asset. So that's not an issue for us that it's a factory building. But they tell you, asset 2 is a factory building with a cost of R1,000,000. So asset 2 cost R1,000,000. How much did we sell asset 1 for? For 1.2 million rands. So because that cost is not 1.2 million or more, we can't apply paragraph 65. So I want you to just now see what happens in situation A. We calculate a normal recoupment. However, we can't apply paragraph 65. But because this is a factory building, we can apply section 13.3. This only applies to factory buildings, remember. And what you can do is you can take that cost or that recoupment and you can knock it off against the cost of the asset, asset 2. Can you see when you're calculating the allowance? So you reduce the cost of the asset. But look at the capital gain. The capital gain is still calculated as normal and you get taxed on it in full in this year. Why? Because paragraph 65 does not apply. Now B. Asset 1 is a factory and asset 2 is also a factory, but now asset 2 costs 1.5 million. So it costs 1.2 or more. So let's see what happens then. Okay, so we calculate the recoupment of 150,000 rands. Now we will apply paragraph 65. We calculate a capital gain of 200,000 rands. We will apply paragraph 65. So I want you to see that capital gain is not included. Can you see? And this capital gain is not included in the CGT column. What do we do with it? Well, the answer lies with asset 2, the new asset. So you are writing asset 2 off times 5%. So when you now recognize the recoupment of 150,000 and the capital gain of 150,000, you will do whatever you did to asset 2. So multiply it by 5%. Make sure you see where it goes in the columns. Right, let's try asset C quickly. Asset 1 is a manufacturing machine and asset 2 is a factory building. So it's a manufacturing machine replaced with a building. You can do this under paragraph 65. And then they tell you that the 1.2 million rands was used to buy for it. Right, so we can apply it. So I want you to see under C, under C, there's the recoupment. We don't include it in our rands column because we're deferring it. There's the capital gain. We don't include it in our CGT column because we're deferring it. Asset 2 is a factory building, so we're writing it off times 5%. So the recoupment and the capital gain, we will also write off or recognize at 5%. Okay, compare that then now to asset F. Asset 1 is a manufacturing machine and asset 2 is a computer with a cost of 1.5 million rands. So they use that to buy a computer, and our computers are written off over 3 years. So F, see what we do in F. So we calculate the recoupment 800,000 rands. See, it is not included because it's deferred. We calculate the capital gain, deferred. Now asset 2 is written off. We divide it by 3 times 2 over 12. So what do we do with our recoupment and our capital gain? We divide it by 3 and we times it by 2 over 12. So you can see, guys, whatever you're doing with the new asset. Now, the one I just want you to see, what I want us to compare, is situation B. Situation B, I'm just reminding you, is the one where we had a factory and we replaced it with another factory. When we did it, we saw that there was a recoupment of 150,000, which we couldn't tax because it's deferred, and a capital gain, which is deferred. The new factory was written off at 5%, so we calculated the recoupment and the deferral at 5%. Now compare that to example 2. So example 2 is the same situation. The only difference is here they sold the asset for 1.2. So it is not an involuntary disposal. Well, the rest of the question, the amount, everything is the same. So look at B. Asset 1 is a factory and asset 2 is a factory. Now remember, paragraph 66 is not applicable to buildings. So what does it mean for us? When we calculate number B now, there's our capital, our recoupment. However, we're not including it because paragraph 66 applies. There's our capital gain. Can you see we are including it in our CGT column because paragraph 66 does not apply. What do we do with the recoupment? If it's a factory building, you can knock it off. If it was not a factory building, like we see in situation C, where it was a machine replaced with a building, right? Situation C was a machine replaced with a building. So I want you to see what happens. The 800,000 rands gets taxed. Can you see? Because paragraph 66 cannot apply. Section 13.3 cannot apply because both assets were in factories. Capital gain, 200,000, gets taxed because paragraph 66 does not apply. Okay, so that's very, very important for you to see.